The S&P 500 is near record highs. The fear gauge is at its calmest level since January. On paper, the stock market looks peaceful, but underneath that calm surface, there's a war going on. Individual stocks, especially in tech, are moving like it's the height of a crisis. Volatility is near a one-year high for single names. Options premiums are exploding, and traders in the pits are dealing with two completely different realities at the exact same time. This isn't a story about two cities. This is a story about two different markets coexisting in the same stock exchange right now. Today, we're breaking down the record-setting disconnect that's unfolding in trading pits across America, what it means, why it matters, and whether this kind of split has ever happened before. Stay with me. This one gets interesting. Welcome back. I'm Hanshu, and if you care about where the market is really headed, not just where the headline index is, you're going to want to watch this entire video. Let's start with what's actually happening. As of late May 2026, the S&P 500 is grinding higher, the headline index is calm, and the CBOE volatility index, what Wall Street calls the VIX or the fear gauge, just touched 15.6. Now, to put that in context, back in March of this year, the VIX was sitting at 35. That's more than double. That was when geopolitical fears around the conflict with Iran were sending markets into daily whipsaw moves. Traders were anxious, hedging was expensive, and every morning felt like you were walking into a potential powder keg. Today, at the index level, that anxiety is almost entirely gone. But here's the twist. If you are not just watching the index, if you are actually trading individual stocks, especially in the technology sector, the roller coaster ride has not stopped. In fact, for many names, it's gotten significantly more intense. And that right there is the disconnect. The calm you see on the surface of the S&P 500 is hiding something very different underneath. And understanding what's under the hood right now could be the most important thing you do as an investor or trader this summer. Most people know the VIX. It's been around since 1993. It measures the expected volatility of the S&P 500 index over the next 30 days, derived from options prices. When the VIX is low, the market is calm. When it spikes, traders are scared. But there's a lesser-known volatility index that's been making big waves lately. It's called the VIXEQ, the S&P 500 Constituent Volatility Index, published by Cboe Global Markets. Here's what makes VIXEQ different. Instead of measuring how volatile the index is expected to be, it aggregates VIX-like measurements for each individual company inside the S&P 500 and then weights them by market cap. Think of it this way. The regular VIX looks at the whole orchestra and asks, how loud is the performance? The VIX EQ goes instrument by instrument and asks, how loud is each musician? And right now, the musicians are screaming, even while the overall performance sounds quiet. As of May 29, 2026, the spread between the VIXEQ and the VIX is the widest it has been since January 2023, which is as far back as Cboe's stock-specific data goes. That's a record. We are in uncharted territory, and I want to be very clear about what this means. It means the calm you see in the S&P 500 right now is, in a sense, a mathematical illusion. When you have 500 stocks moving in different directions with high individual volatility, the gains and losses can cancel each other out, leaving the index looking flat or even gently rising. But make no mistake, the components are anything but calm. So what's actually driving this? Why are individual stocks so volatile when the index itself looks like a flat lake on a windless day? Mandy Xu, the head of derivatives market intelligence at CBE, put it perfectly. She wrote, and I'm paraphrasing here, that what stands out in the current market is just how calm things are at the index level, even as single stock volatility remains near a one-year high. She pointed to two main drivers. Number one, stock dispersion is extremely elevated. Number two, correlation levels have fallen to historic lows. Let's unpack both of those. Stock dispersion means stocks are moving in very different directions from one another. When the big guys go up and the small guys go down, or tech surges while energy tanks, the index can hide the chaos underneath. And correlation, or the lack of it, is the other key piece. When stocks are highly correlated, they tend to move together. When correlation falls, they go their own ways. Right now, correlation is at historic lows. That means each stock is being traded on its own story, its own fundamentals, its own catalysts. And what are those catalysts right now? Two big ones: AI and earnings. With the artificial intelligence boom reshaping the semiconductor industry at a pace nobody quite anticipated, individual companies are getting enormous company-specific news, new chip deals, new data center contracts, surprise revenue beats. And each one of those events sends that one stock flying, often by double digits in a single session, while the rest of the index barely moves. Meanwhile, the big macro fears, the Iran conflict, the tariff shock of early 2025, the Federal Reserve's rate uncertainty, have faded somewhat from center stage. Traders are no longer all running in the same direction at once. Instead, it's a pick-your-poison stock-by-stock market. Now let me give you the most striking concrete example of this disconnect in action: semiconductors. The VanEck Semiconductor ETF, the SMH, has implied volatility of around 50% right now. That is near the highest level in a year, and that's already more than 3 times higher than the implied volatility of the S&P 500 as a whole. But the ETF is just the beginning. When you drill down to individual chip stocks, the numbers get wild. Take Micron technology. Micron has been at the center of the AL memory boom. The company makes high-bandwidth memory chips that are essential for training and running large AL models. The stock has been on a tear, rising over 800% in the past year at points, and its implied volatility, it hit 101%. Let me say that again: 101% implied volatility on a major U.S. chip stock. Graphic: Micron implied vol versus S&P 500 implied vol. To put that in plain English, the options market is pricing in the possibility that Micron stock could move, in either direction, by an amount roughly equal to its entire value over the course of a year. That is an extraordinary level of uncertainty, and traders are acting accordingly. According to data from Citadel Securities, gross options premium being traded across semiconductors is now 25% above the prior record, which was set back in March 2024, and it's running at 5 times the historical monthly average, 5 times, not 50% above average, 5 times the normal level. This is a market that, at the individual stock level, is behaving like we're in the middle of a historic frenzy, even while the headline index suggests everything is fine. Now, this might sound like a technical story, something only quantitative traders or hedge fund analysts care about, but the implications are actually very real, whether you trade options or not. Here's why the volatility spread between single stocks and the index is such a big deal. Options traders make risk-reward decisions based on something called implied volatility. When implied volatility is high, options are expensive. When it's low, they're cheap. And the relationship between index vol and single stock vol shapes how traders position themselves every single day. Right now, if you want to buy index-level protection, say put options on the S&P 500 as a hedge, it's relatively cheap. The VIX is at 15.6. Hedging at the index level doesn't cost you much, but if you want to play a specific semiconductor name, either buying calls to ride the AL wave or buying puts to protect against a crash, you're paying through the nose. Implied volatility at 100% means those options are extremely expensive. And here's another important implication: it creates what traders call a dispersion trade opportunity. Sophisticated traders can simultaneously sell index volatility, which is cheap, and buy or sell individual stock volatility, which is expensive, and potentially profit from the difference. This is exactly the kind of environment where the gap between what Wall Street knows and what Main Street sees gets widest. The headline says VIX is calm, but in the trading pits, there's a full-scale volatility arms race happening under the surface. To fully understand this moment, we need to zoom out a little and trace how we got here. The year started with escalating geopolitical tensions. The U.S. conflict with Iran pushed the VIX above 30 in March, a level that